Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. My role here, a lot of people don't know. Many different hats. I do a lot of talking about property. I'm the managing editor of Real Estate and Financial Services at Momentum Media, journalist by trade. Probably not that good a journalist, or not a good writer, probably more of a podcaster, but I get the benefit, the privilege of being able to cross the whole spectrum that is financial services and real estate. So I get to meet a lot of people and chat to a lot of people from industry and the profession and punters who are trying to make some money out of property or financial services in general. And by there I'm talking about through financial planners, shares, bonds, other type of asset classes, the government. Speak to people in the government a fair bit. And it sort of encourages me that despite some of the headwinds that we face, we're surrounded in Australia by a cadre of professionals who are all out there trying to help Australian investors create a better future for themselves. So that's a lot of my discussions, and I like to fly the flag around that. Fortunately, I have a group of people that I work with that help me make better decisions when it comes to my financial future. And it's something that I'll continue to get on this podcast, people to come and have a yarn about what's going on. So hopefully you can be better informed and make better investment decisions, particularly around real estate, which is what we're talking about today. One area which is growing rapidly and has been for some time now, and I see a lot of growth still moving forward, is around the whole property strategy, buyer's agent, buyer's advocacy side of things. And we're putting a lot of thought into it at Smart Property Investment to work out how we can be even more supportive. But one of the ways we support is we get them on the podcast, people to come and have a chat with us about what's going on. And our guest today, he's been a bit AWOL on the show for a little while. That's probably more my fault than his. Lachlan Vidler. He's a director at Atlas Property Group. He's also on the board of PIPA, which is the Property Investment Professionals of Australia. Which is a really good outfit, association helping to shape better governance, better rigour, better policies around property investment for Australian investors, but also the professions themselves. I was on the board for many years, but I sort of hung up my hat and passed it over to people that know more about it than me, Lachlan being one of them. Lachlan, how you going?
Hello, Phil. Good morning.
Are you happy?
Am I happy? That's a really philosophical question, isn't
happy.
it?
I know. You go to start off with. Is life good for Lachlan?
Is life good for me? Yeah, life's pretty good. We're nice and busy, lots going on. So, work front's great, personal front's great. Just, we're coming we're in spring, where shortly we'll have summer upon us. So I think it's a great time of year.
It's a great time of year. I don't know how we got to, and everyone says it up to October so quickly when it was just Christmas. So I don't know, time flies when you're having fun maybe. But there's a lot of fun in real estate, and with a bit of stability now in interest rates. So the new Reserve Bank governor kept things steady as it goes when she met, or the board met this month. So hopefully that continues. Whether or not we're going to start seeing downward trend in interest rates, when that's going to happen, who knows? But what are you seeing, Lachlan? I always like getting you on just to get a bit of there's a whole bunch of stuff I want to talk to you about today, mainly about sort of building, scalable retirement portfolios, which is what everyone wants to do in property.
Absolutely.
And the plan and the capabilities around it. I know you've got your own application to how you go about doing it. So I really want to dig into your sort of system or process for acquiring, but also maintaining and monitoring. And I hear my people tell me you've got something you're going to unveil in this podcast, and I don't know what it is. So
yes, your people are correct.
Do you want to wait to the back end of it, or you want to do it at the front end? What's going to be easier? We do it at the back end. It probably gives more context.
It's probably a bit more exciting. And you know what? It actually probably fits with our discussion a bit better. Yeah, let's do that. Let's leave it to the back.
The suspense is there, but I know Lachlan's not anyone to sit idle. How long have you been doing this now?
We're about I think around the 4-year mark now.
Wow.
Yeah, I'd have to actually go on look at the dates
you
of it.
You should know your incorporation date.
I know. It's probably, maybe I'm a bad business owner.
What's the address of the first property you ever sold professionally as a buyer's agent?
Oh, the first property, it was in Bendigo.
Okay.
It was in Bendigo. It was on a street called McDougall Road.
There you go.
Yeah, I won't say the number for obvious reasons, I still remember the very first one.
So it was the first professional.
Professional. Yeah. Proper professional.
Yeah.
A lot of P's there. Proper professional.
A lot of P's. A lot of P's in property.
Yeah.
Performance being one of them, obviously. The performance of your portfolio and the persistent performance of your portfolio perpetually.
Yeah.
Is a good.
It's a bit of alliteration.
Yeah, whatever. I can still pull this stuff out. A journalist, but but what's going on with the markets?
Yeah.
Stable, good, up, down, mate. You read the papers, and it's a bit of a mixed bag. Some properties going way over reserves at auction. I think the clearance rate last weekend was about 70%, which is 65. Which is sort of quite typical. Some good properties are selling for good prices.
Absolutely. Yeah. I mean, I think. Look, I think the market, if we just talk in a real macro aggregate sense, I think the market's great. I mean, I don't know if you'd remember when I brought on one of my clients at the end of last year, Zoe, and we had a really great chat, and she, talked obviously a lot about her great experience with us, but she obviously talked about her journey too. I mean, even for the start of this year, and I promise there's a point to this, is after we had that chat with her, we finished buying, I don't know, whatever number property it was for her. And between sort of November, December last year through to about June, July this year, which was, about 6 months, she then sent me a message and the property we'd bought for her had gone up by sort of 16, 17%. It was like $90,000 over that period. And that was when allegedly the market was awful, right? Or no one can see it, but I'm doing inverted commas here.
We're on the video
here.
On the video. We're on the internet and the YouTube. So
on the YouTube.
On the YouTube.
But yeah, so, that was the sort of, things we were seeing. And obviously I think that's a real testament to the team and the process and that we implement to get those results. But that was what was happening when the media was saying it was awful. And I think now things are at that macro aggregate scale looking quite good from an investment front. So there's obviously, some fundamental issues still out there in the property market from a, maybe from a rental perspective and how that might impact people looking for a property. And we obviously feel for them in that sense. But property investing is a business. And for the people who are being able to invest in property or own investment properties, I would say things are in a really, really good position, and it really sets the scene or the tone for the end of 23 and definitely into 24, because more than anything else, there is a crisis of available properties.
And that's the point. So, and you hear people talking about, spring, there's heaps of properties coming onto the market. There's got to be more competition because of the result of more listings coming out. But if you dig into the numbers, I know you're a numbers guy. There might be more listings comparative to a very immediate past, but compared to other years, listings are down at this point in time, and people needing properties for sale is up. So demand is up. So this is the dichotomy that we're sitting in right now. If you look at near past, it doesn't really move the needle, but it's dire out there.
Absolutely. I think I saw, I'm sure if I'm wrong, somebody will write in and quote me on this, but I think I saw a recent stat was it was either we've just had it in the 12-month period gone by or over sort of, maybe this calendar year or financial year. It was basically this sort of immediacy period that they're expecting about 523 migrants, to come out here and live and work and do all sorts of things. That's a massive number, right? And that will obviously pull back, but that's a huge number. And we look at something like listings, right? Latest data.
523.
523,000. Yeah, that's what I mean. Sort of in a 12-month period. I can't remember if it was just happened or it's sort of happening right now. But, compared to 12 months ago, and like you said, big numbers guy, love the data. It really helps to, it helps you to tell a story. Because I think a lot of what we do as a professional in this industry, we have to be able to tell a good story. Because if you can't, it's then just ones and zeros on a page, or it's I walked this street and I saw a shop that was closed. But you need to tell a story. We're all storytellers at heart, or those of us that think that we're able to do a really good job for our clients. But we look at some of the numbers. Last year, it was down as from a listings point of view, right? So we talk about the supply side. It was down. A big story last year before was, where are all the properties?
Wherever all the properties gone. Sounds like a song.
Exactly right. It sounds like a song. And if the tune hasn't changed this year, the melody is exactly as it was last year. Actually, that's a lie. It's worse, right? Right now, we're about 11% down on where we were this time last year. And if we look even longer, we're running 20 to 25% below the 5-year averages. And that's without us having some of the biggest migrations, in potentially recent history. There are so many factors. And it honestly, I'm going to be honest and say, it actually scares me a little bit, because if you're not in an investment property right now, it's going to get harder. But those that are, there is going to be a lot of wealth that's created. And that's, you know me, I don't make a lot of guarantees, and I don't try and, crystal ball things, but I can crystal ball that, because it is, from simple economics, it is inevitable right now.
Yeah, I saw a piece this morning. I think it was on Real Estate Business from John McGrath. I think I only saw it briefly, but it caught my attention, which pretty much essentially buyers that are brave in this market will be the ones that do really well in the future. And that pretty much echoes the sentiment that you've just said.
Yeah. And you know what? I'm going to take that one step further. And I'm going to say, I genuinely don't even think you need to be brave, right? To me right now, I look at the market, and it's not like we're sitting here and we've got, we've just lost 25% of the market value. We haven't had a good period of growth in a long time. And we're trying to sit here and say to people, hey, it's promising, like there is light at the end of this tunnel. Yeah. Like even right now, over the last 3 months, we're running at about a 2.5% national increase in housing values, which when you take that out to an annualized rate, that's 10.5% annualized growth that we're running at right now. So while I love the sentiment from John McGrath, I'm taking it one step further.
Well, I like you back yourself, and I actually got that right. I just clocked it. It's just the subject line I remember saying. But story here is John McGrath, the market will reward the brave who buy now, and I'm happy to talk about John because he's well regarded in real estate from McGrath. The network CEO has aired some lessons he learned to GFC, not advising buyers to act, but pinpointing some markets that remind. Because I think they've just done a big report. Prepare for takeoff is what he called it. Prepared for takeoff. McGrath spoke in terms of that framed the property market. He said it was challenging. Those able to navigate this volatile economic period would see their homes value start to rise probably sooner than you think.
Yeah, well, I mean, as
you're
I
seeing
said,
it already.
It's already out there.
So the quarterly growth was 2.5%.
Yeah,
right? Annualized at 10.
Yeah,
it's a blunt to say, okay, well, 4 times that is this, but
you have to work with the data.
Yeah, absolutely. But it bucks the trend of what you. Oh, maybe you're not seeing as much in the media right now around the dire.
No,
you're not seeing the dire state of price values.
Have you noticed that narrative? At just one day it was
changed.
There, and then it was gone.
It's completely changed. But on the other side of it now, it's back to affordability. It's unaffordable housing. It's unaffordable.
Absolutely.
It was unaffordable when prices were down.
Well, and it's. I think that the smart property investment listeners are probably far more educated on average than the regular. Yeah, hearing your voice every twice a week, isn't it?
Unfortunately,
yeah.
Unfortunately, it's twice a week.
But I think that because of that, I think that we can have that good discussion here and really, call out some things. And the media, and I know obviously Momentum is a media company, but we'll put Momentum to the side.
Media. Don't bundle us up with the clickbait crew.
No. But I guess the media in that macro sense, the big papers, the big this, the big that, they have to sell eyeballs, right? Clicks and eyeballs, right? That's what they're going for. And you notice one day it's all about how it's doom and gloom, and now it's all about how it's unaffordable and our prices are going up, and there's this and there's that. I mean, again, some more data. We've just hit the lowest national vacancy rate in a very long time, maybe ever.
So explain vacancy rates for those people who may be new to property.
Okay, that's a good point. So if you are new to property, vacancy rates, it's basically a measurement of all the available properties for rent in a certain area, right? That's the simple explanation. The way it's calculated differs, right? And I think a bit more of the standard way is if a property sits there for I think more than about 3 weeks, it's termed vacant, right? And then that gives a good measure, because if a market's really hot, nothing's going to sit there for 3 weeks waiting to put a tenant in. But if the market's really slow, it might take you 5-6 weeks, right? Especially if you're not in a great market. So 3 weeks is, I think, where a lot of people benchmark it. But it's a ratio, right? So right now it's sitting at about 1.1%, right? If you think about that, I mean, the difference between 1.1 and 0.8 is probably a rounding error in a lot of cases. You know, there'd be a lot of markets out there where the vacancy rate's 0, right? So the narrative, we keep talking about the narrative, right? Or how there sometimes is a bit of a narrative out there for those eyeballs. Well, that's an eyeball and click-worthy number.
Yeah, and to be a cynic, being a journalist, it's not normally cynical people, but the major mastheads, let's call them that. You know,
We'll do that. You'll get momentum out of it. We'll talk
the major
about
mastheads. They make most of their advertising dollars from the real estate sector. And traditionally they have done, right?
Really?
And it used to be all the local papers were full of just real estate advertising. Real estate agents pretty much paid the bills for these papers. Yeah. And back in the day is where you used to look for properties was in a paper, right? You send them back. Now that's all gone online. Realestate.com, for example, which is largely owned by media. It's a media company, right? Yeah. So they're intrinsically connected with real estate in Australia, and what people read on those papers is therefore connected in with the economics of real estate. Good or bad, it's just. But what it says is that real estate touches every aspect of Australia and the Australian economy. I think 1 in 8 people in Australia work in real estate.
Really?
Yep.
Wow.
With construction, like trade.
Oh, true.
You think of every tradie works in real estate.
Yep. Yeah, that makes sense.
Tradie works in real estate, right? So therefore, you know, Toyota is intrinsically connected with real estate in Australia because it's still the number one selling car, I think, or it's the number one selling ute in Australia. Maybe it might be dwarfed by the Ranger or something.
I was going to say, have you seen these big utes coming out?
Yeah, the American.
Oh my God! Yeah, getting
the American Silverados and whatnot. Again, connected with real estate. Yeah. Real estate drives the nations. Hence the reason why everyone talks about it, and therefore one of the reasons why if you orientate yourself effectively around real estate, if you're an occupier, great, but as a property investor, it's where you can create wealth. And this goes to the point around why people invest in property to support retirement. But you're talking about vacancy rates in rental accommodation, which is as low as it can probably get, right?
Yeah.
Because a lot of people who state governments are trying to tax empty properties where people just buy it for a tax deduction and they write it off, right? But running in parallel with record low interest rates is rents are rising at a rate which hasn't been seen for many, many years. So when you look at it, you go, God, how do you make sense for it all?
Well, I think the thing...
real estate, probably is probably what you'll say. But
well, I was actually having this conversation with somebody yesterday. And you know how you just think of random things you've heard across your life and it just pops up to you. And I can't remember what the context was yesterday. But actually, I was meeting with a broker. And we're just talking about, you know, investing and getting out and all that sort of stuff. And when I was in the Navy, there was a really good phrase that, maybe phrase is the wrong word, but I guess analogy that was said to us. And when we were learning to drive a ship,
when you're learning to drive a ship. Yeah. By the way, the wheel of a ship is pretty small. It's the size of a dinner plate, right?
Absolutely. Very, very, very small. And when you're sitting there and standing there and you're trying to work out exactly, you know, what direction you should be going. Are you on the right navigation path? Are you left of it? Are you right of it? What's going on? A lot of people, when they're in the early stage of learning to do that, they can get really fixated on having their head down, right? They're looking at the chart. They're looking at the displays. They're looking at all this. And a phrase that often gets thrown around is, you know, don't forget to look out the window, right? And the reason for that is it's all good and well to look at all this stuff. Sometimes you've got to put your head up and you've got to look out, and that can tell you more than what some ones and zeros on a display or, you know, on a spreadsheet for property is going to tell you. And the reason I'm bringing this story up is you said, how do we make sense of this? And I think for a lot of people, it's really hard to conceptually understand that property will continue to grow, right? If we flip back to the 90s, like early mid 90s, average home price in Sydney was, I think, about it was either mid twos or low threes, 100,000s, right? And if you ask somebody back in 1992 or 1990, do you think that the median price in Sydney could ever get to 1.5 million? They would have said, you are out of your mind, right? And what's happened? Well, we've already cracked that. You know, we're already at that point, and with all the, you know, the change we've seen over the last few years, we cracked that, right? So how do we make sense of this? What we need to do is we need to understand that prices will increase, right? Rents will increase. Of course, it's not always going to end up at this massively accelerated rate that we are right now. But with 523,000 migrants coming in, with the lowest levels of building possibly ever, with an absolute shortage of properties. I think I read a report from the government housing body that said by 2030 we're going to be running at about, I think it was about 130,000 dwellings a year short of where we need to be. With all these things, even somebody with the most basic grasp of economics and supply and demand should be able to understand that it might not seem logical. Oh, sorry, I'll take that back. It should seem logical. It might not seem realistic, but these things are going to continue to happen. And that's why, despite the fact we've had, about 4 percentage point increase to the cash rate, and by all levels of common sense, you would say property prices, the arse should have dropped out of the market. It really didn't.
Yeah. And we haven't seen anyone come out from America recently reminding us that our property market here is 40% overvalued and it's just waiting for a crash, right? And economists would respond by saying it's different here than what it is in other parts of the world. And just the fact of this basic supply and demand.
Yeah.
There's not enough properties for people that want to live into Australia. And if Australia needs to evolve and grow and maintain its prosperity by attracting migrants, we need the housing. That said, our state governments are intrinsically connected with the property market for running the states. What do you call it? Stamp duty and land tax.
Yeah.
It's two of the big three taxes they get. The rest is from businesses in payroll tax. And the federal government needs to provide housing. That said, also the strength of our banks' balance sheets is buoyed up by real estate and mortgages. So everyone's in this together, right? So what you're pointing out here in terms of market conditions is that there's still a lot of noise. There's still a lot of people who are uncertain about market conditions, but it is growing largely. Good locations are growing.
Yeah.
And the numbers coming out there. We'll keep an eye on that moving forward. And even though you're getting more stock on market than what it was in the recent history, it's still low compared to how it was or where it was in the past. So there's still not a lot of liquidity in property. They're not turning over as much as what they used to. And that needs to be accelerated.
Yeah, and I guess this is where it comes to a lot of what we're going to discuss for the rest of the episode, which is
what do you do about it?
Exactly right. How does somebody go and set about building that scalable retirement level portfolio with the way banks are set up now? Just to throw back to what you're saying before, we are fundamentally set up different, right? The banking changes that happened globally post the GFC mandated certain levels of liquidity in banks. And to get a bit technical with people, they're called the Basel Accords. It mandated certain levels of liquidity at banks, and it's done into capital tiers and things like that.
And that is that banks need to keep a certain amount of money in cash money if they need it.
In cash money, exactly right.
Yeah.
Australian banks have taken that much further than what the mandated minimums are. And because of that, that's why we see, a lot of people talk about, it's so hard to get a mortgage. It's so difficult to do this. It's hard to invest in properties. And you're right. But the reason why it is the same reason that we don't have dropouts in our market the way that the Irish did a few years ago. The Americans have had a number of times. We are supported, and it's those protections that actually assist us to have a very well-functioning property market. And that's why when you're trying to build that scalable retirement level portfolio, you have to understand the right steps to put in place, because otherwise you might enact things that worked 20 years ago that won't work now.
Yeah. And it's simple also. People want to live in Australia.
Exactly.
People want to live in Australia, and you only need to think about what's happening globally. And for those Australians who haven't put their head up and out and looked outside of Australia and how other parts of the world operate, there's a lot of people living in very distressful situations. We have your war in Europe. We've seen Middle East now ablaze. It's a good place to live.
Absolutely.
It's a good place to live, Australia. And that will also dictate and determine how property markets continue to grow. But it's all about what do you do about it? Okay, it all sounds very good. And you talk about building a scalable retirement portfolio. Let's dig into it, Lachlan. We'll just go to a quick break. Stay with us back in a moment. Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. I'm with the Director of Atlas Property Group, Lachlan Vidler. give us some sense what's going on in the market. And I think we both agree. We're both property people, I guess you would say. And you know, I've hosted this podcast for many years now. Through a lot of the challenges and changes APRA had at the latter part, I think it was 2017, 2018, putting different sort of rules and requirements around lending to investors, slowed things down. I've narrated the COVID pandemic on this podcast, which at some point in time I'll go back and listen to the first time I mentioned COVID on the Smart Property Investment Show, and I could probably guarantee I was probably pretty defensive to property markets, even though the world was going mad, right? Yeah. And one day I'll do a bit of a mixtape on that just to see how right or wrong I got that. And we were chatting through that process as well, Lachlan. But with a view towards the inherent strength of Australian property and largely its predictability as a vehicle for wealth creation into the future with an eye towards history, and history gives us lots and lots of clues about how things are going to move forward. People tuning into this podcast are all about, okay, I'm either in the game and I'm playing the game and they want to play it better, or they want to get in the game.
Yeah.
And the key to anyone entering property and those people with a established or a growing a real estate portfolio is how do you create a scalable retirement portfolio? And I know this is big for you and your clients, and it's very much a doctrine that you use to help develop what you do for your clients moving forward. It's got to be a scalable portfolio built for optionality.
Yeah.
One of them might be retirement. Yep. One might be to pass it on, estate planning, whatever you choose to do with it. So I guess key to that is that it's got to be self-sufficient, right? You don't want to be feeding the beast too much.
Yeah, absolutely. And I mean, that's one of the big things, right? I'd say for all the clients who come to us, and we'll talk about it probably in the next point more so, but one of the really key things is that most people want income. Like an analogy that I give everyone is equity's great. We all want equity. That's fine. You know, that's a natural part. And for the most part, that will organically happen over time. But when we're talking about that retirement level portfolio, income is what lets you go buy milk from the corner store. You know, it's equity doesn't. You can't walk down there to the shopkeeper and say, "Oh, excuse me, Mr. Shopkeeper, I've got this property. I live here in Mossman or wherever." And
do you take Bitcoin? You take equity.
Exactly right. You know, can't just rip out a brick from the house and say this brick's now worth this amount. So, for most people, when they're talking about that retirement level and scalable portfolio, it often comes back to income. And if a portfolio isn't self-sufficient, it's definitely not going to be giving you an income. So it's got to be able to support itself, and that can take some time, right? That can take some time, but it has to be self-sufficient for sure.
Yeah, and I look at my portfolio, and it performs pretty well. It's been great on the equity front, but I'm in the process of recalibrating it now because I want more income. I want equity and income.
There you go.
Equity and income. I don't really want to tipping it, and income becomes more profound when interest rates are higher. Yeah. And there's a lot of people who have been sitting around probably, and I know the Smart Property Investment portfolio was like this for a period of time, where it wasn't costing too much to hold it, even though we had principal and interest mortgages, and our mortgage rate probably wasn't as good as what else you would get out there as a new customer, but it gets harder. But when interest rates start going up, people start going, hang on a second, that money that used to be positive in my bank account every month is now negative, and this is starting to become a problem. Are you seeing, it's tough at the moment, but are you seeing, or is it still achievable to have positively geared residential real estate portfolio in this market?
I guess there's a few things to that question. So the first thing that I would say is it firstly depends on your definition. So for me, I'm a finance guy, and I take a very literal definition, right? And for me, the literal definition is that is based on interest. Because if you're making principal and interest repayments, principal is a choice. Principal is like forced savings.
I agree.
It's not a cost of debt, right? Yep. So when I'm evaluating whether a property is, cash flow positive or cash flow neutral or cash flow negative, I'm basing it off predominantly the cost of debt, because that's the biggest lever when we're talking about that, right? The other expenses, sure, but it pales in comparison to...
Yeah, it's got to be 70, 80% of your cost base is going to be interest.
Right. Absolutely.
If you're financed at sort of 80%.
Exactly right, yeah. So that's the first part, right? We'll go
I'm okay with that. I'm okay with that definition.
Okay. Awesome. Yeah. So then the answer to the question is, it is harder. And I think what I'm saying to a lot of our clients we work with or potential clients is good properties are good properties. It doesn't matter whether it is whether it's we're having this conversation 2 years ago and rates could have had a 1 or a 2 in front of them, or whether we're having them now and some rates have got a 5 or a 6, or depending on your vehicle, it might be a 7 or an 8 if you're in super or trusts or things like that. Good properties and the way we build a portfolio, and we'll chat about that in a second in more detail, but good properties that fit what needs to be done today remain the same. And if that means right now you're taking a short-term hit and maybe you're, 3 or 4K in the red on a property to start with, because maybe the bank won't offer you something as attractive as a different person. And as we said, it's maybe 70 to 80% of the cost base. That's okay, right? It's not the best, of course, but that's okay, because as rates start to come down, likely, next year, right? Likely not even the end of next year either. And as rents continue to compound, that's a big double whammy, right? Because rates, that's a big lever of what your repayments are. And then if you're making more money each week out of your rent, I'm sure everyone can see why that is a big heavy lifter. And it might mean that you've only got 12 months of that, and you could easily have a 3 or 4K swing. Easily, right? If interest rates drop 1%, which I don't think is crazy, right? Considering where they are.
Next year or over the course of a couple of years. Who knows?
Yeah, I mean, I'm not
probably outside our wheelhouse.
Yeah, I'm not one to predict, but I think, just conceptually the idea of rates coming down 1 single percent is not crazy, right? Like to go from 2% to 1%, that's a big jump. But going from 6% down to 5%, not that crazy.
Well, there's going to be less opportunities now for the Reserve Bank to muddle with or fiddle with interest rates, because I think they're only meeting 8 times a year as of next year.
Yeah, that's the changes.
So are they going to go in 25 basis points increments, or are they going to go in bigger whacks? Who knows? Who knows? But the government wants growth, and
right.
The RBA's job is to just sit there and just find the fine balance of it all. But most economists are predicting an interest rate cut.
Yeah, it's coming,
and most starting in 2024. Yeah. Maybe this time next year.
It is absolutely coming. Yeah. You and I never sit here and do predictions with each other. I don't know what happens when you bring other guests on, but with me,
I don't predict. It's not my job to do so. I talk to people about predictions, and I try and get them to predict. Try and trick them into a prediction so I can hold them to a court. But you're smart enough for that, too smart for that.
But yeah, so I think everybody knows, right? The rate cuts are coming, okay? Maybe there might be one more increase. There has been a bit of chatter around that, but even if that is the case, we're certainly not in the position where we're looking at, 5 more increases, probably even 3 more increases, right? We're probably looking at maybe 1, maybe if things go really poorly, maybe a second, but that doesn't necessarily mean consecutively either. Like, who knows? There's a lot of chatter that November could be an increase. I won't say my piece on that, but even if that happens, will December be another one? If it's needed, probably, obviously if it's needed, they'll do it. But, it doesn't necessarily mean if there's 2, it'll be back to back.
They've kept the door open for it, the Reserve Bank of Australia, but they're going to do that anyway, just because they don't want to be sitting there going, there's not going to be interest rate rises until 2024, right? I think they've learned their lesson, right?
I was going to say they've learned their lesson.
I call it strategic ambiguity.
Oh, that's a good one, strategic ambiguity. I think
you just don't know.
Yes, former Governor Lowe learnt that the very hard way. And, I feel for the bloke, right? He was trying to give people certainty when it probably wasn't his job, but it was a very trying and testing period. And I do feel for the guy, because
he's going to get remembered for that rather than probably a lot of the good work that he's done.
And it's, it's the curse. I mean, we don't get too political, but, at least in this country, the difference between Labor and Liberal, very, very minor. Compared to other countries in the world where we talk about the right and left, very minor. And yet, most of our governments as well, they get remembered for the poor things rather than, regardless of where your affiliations lie, the 95% great work they do.
Nature of the beast.
Exactly right.
And if you want to go into politics, you've got to expect that's the way it is. But I guess the key thing with a scalable retirement portfolio, and you talk about it being self-sufficient, right, is that if it's self-sufficient, there's largely no ceiling other than your capacity to continue growing it based on your serviceability, which is intrinsically connected with the markets and what you earn and all that sort of stuff.
Yeah, I would say that's a great way to summarize the concept, because, there are a lot of ways you can do it, and people can look at different vehicles for owning property and how that may or may not impact things like borrowing capacity and asset protection. And I'm sure there's a lot of listeners who can read between the lines of those comments. There are ways that you can do that, and it gets you to the point where your portfolio, if it's achieving that scalability and it's hitting that retirement level, or more importantly, it's along that trajectory because it doesn't happen overnight, you will be in a position where you can be in that 9% of investors who have more than 2 properties.
That's crazy, isn't it? It's only 9%.
It's only 91. So flip it. 91% only own 1 or 2 properties. So I think the number's about 70% are 1, and then it's about 20.5. I think I rounded up for it. I think it's about 20.5 is 2 properties.
It's crazy, isn't it? Because you're in and around property all the time, you sort of forget, right?
Yeah.
But it is a niche.
Well, I've got an answer for you. I've worked out why it is.
Okay, tell me.
The reason why it is because a lot of people are building portfolios without plans. And when they're doing it because they're building from how you could have built it 20 years ago. It was a comment I made earlier in the episode, 20 years ago. But now there was some sort of study and research done. The average property investment loss is $14,500 a year.
Per property?
Per property.
Really?
$14,500.
I don't know about that because
That was from ATO. That was from the ATO stats. Yep. Which to me,
I've got a lot of property, right?
Yeah.
Well, I've sold a bit recently, but for it to be losing that at an aggregate level, and this is sort of mum and dad type properties, what I'm talking about. It's you've got to have a lot of debt on there, and milking it for equity.
Think about this, right? To me, that actually really explains that 91% that only own 1 or 2.
Yeah.
Because
where are you going to find 14 grand from?
Exactly
That's
right.
a tax loss, though. It's not a cash flow.
No, that was cash loss.
That's cash loss.
So you think how that impacts your borrowing?
So pre-tax.
Post-tax.
Post-tax.
Yeah.
Ooh.
Yeah.
So it's higher.
Yeah.
At a cash level.
Yeah.
Before. Yeah.
Exactly. And obviously that's an average, right?
Yeah.
But you think, I think it was, the number was between about 12 to 16. So I split the middle at 14.
So 91% of people have one of those properties that cost them 14 grand.
Yeah.
14 grand after tax. So
Yeah.
pre-tax cash flow is pretty high.
Yep.
And then the average income or median income in Australia now is $95,000. So people ain't going to have a lot of leftover change.
Think about how that impacts your borrowing, right? So if you own 2 of those properties like that, and because most mum and dad investors, they buy the house next door or they go in the neighbourhood next door, negatively geared. The majority of investors are negatively geared, not really good for building a portfolio. You're hitting those losses. If you're earning 90K, and suddenly you've obviously got to pay tax out of that, and then you've got to deal with a 12 to 16K loss per property. You're ripping through $20,000 to $30,000 off your income. Yeah. How are you going to borrow?
And those numbers would have been when interest rates were probably at 2 and a bit percent.
Exactly right.
So I reckon that number will inflate. So to your point, then it all comes down to the reason why 91% of people probably own between 1 or 2 properties because they don't have a plan.
Exactly right.
But we're talking about building a scalable retirement portfolio, which means that you want it to be self-sufficient, which means you don't want to be burning, to that example, $14,000 a year, which necessarily means right now you're probably not going to be buying, if you're a first-time investor, real estate in Sydney and Melbourne and Brisbane if you want a cash flow positive property.
Absolutely. Or even
that's a reality.
Yeah.
Or even close to.
I was going to say, or to my point before, like even if you're losing, say, 5K, right, or 4K or something, right, which in the scheme of it, that's $100 a week. Like it's not really a lot in the scheme of it.
It's a couple of hipster beers and
exactly. You're getting Uber Eats a little bit less, right? It's not a big thing, and yet you're growing your wealth exponentially. But that is why, right? And that's something that with our clients we work really closely on. So we've built out our own modeling technology.
Do you have a system?
We do.
Do you call it a system?
We do. So we've. I mean, it's a good bit of marketing. I'm sure.
I know. Yeah. But by the way, for those of you who haven't read Lachlan's book, which by memory is called Military Guide to Problem.
It surely is.
Military Guide to Problem Investors. He's an he's always once a Navy man, always a Navy man, but he was in the services and office for quite some time. So I know you mob like systems and processes and protocols and how things are done. So structure to stuff.
Absolutely.
And that's the best thing to plan with is around structure.
Absolutely. And that's what we've done, right? We've, as our business has grown, as we've been able to take the knowledge within the business to do what we needed to do. And then also, to call a spade, right? As we've been able to grow, we've had more clients. It's allowed us the capital to really invest into our own processes to build things out. We've been able to build out our own ability to model out a potential property portfolio for clients to get them towards that retirement.
So this system, if you want to call it a process, is at a portfolio level, but there's probably aspects of that which are modular, and one of them would be the acquisition bit, and then the other bit would be the maintenance bit, and then there'd be a sort of a pay down or retirement bit.
Exactly right.
Yeah,
exactly right. So what we do is we start with clients really understanding where they want to get to, because I find that what happens is people don't know where they go, and if you don't even have a direction, right, very challenging to know if you're going the right way or not, right? So we start out by understanding that, and then we move into where we design a portfolio, and we design the property journey for our clients based on our system, which is, there's different names out there, and I mean, there are some similarities between what some other people might think, but I guess we've really honed that down, really drilled it down, and it's worked well. I mean, like I was telling that story before about our client who was on this show, right? Making her $90,000, 16, 17% in 16 months, right? Proof is in the pudding that it works. In the early days, you really want to start your portfolio out with those properties that are achieving that balance between the cash flow and the growth, right? You're not getting rich off the cash flow, but it's allowing you to be attractive to banks, which is
self-sufficiency.
Vital. Self-sufficiency, exactly right. And then you've got that equity building so that you can then it helps you to buy more properties, right? Now, you'll build out that stage, and for a lot of clients, we say that could be between, say, 3 to 6 of those. It depends your goals, it depends your time frames.
So you get a couple of foundational properties, so you're not one of the 91 percenters.
Exactly right.
But then you need to accelerate out of that.
100%.
Okay.
And that's where we need to shift our focus, right? For some people, they really want to focus on that equity. Now, I'll be honest and say I don't think it's the smartest way, because a lot of that relies on things that you can't predict, and it relies on things you don't have a lot of control over. You also can't buy bread down the corner store, like we were saying earlier. But for most people, they focus down on income. So when you look to accelerate, that's when you're then looking to bring in assets into the portfolio, because the equity is already sitting there in that early stage, right? That's going to keep growing. You're now going to take more of an income focus, right? And that could be through lots of different avenues. Maybe you're looking at multi-family properties, right? So you're doing like duplexes, unit blocks, things like that, triplexes, whatever. Maybe you're looking at commercial property.
This accelerated stuff. So I was going to say, we're not just talking resi property.
Not necessarily.
Not
at all.
You're bundling up some commercial, and there's this sort of misnomer that commercial property doesn't grow at an equity level as fast as resi. It depends who you talk to. There's going to be different debates on that. But what is largely accepted is that commercial property is generally better yielding.
It is. And I would say, to be honest, anyone who says it grows at the same rate may or may not be true, but it's a lot more volatile. And that's the problem, right? If you jump on AFR right now and you do a trawl through the property section of AFR, you will see there is a lot of talk about the volatility of commercial property and
particularly office markets.
Yeah. But residential doesn't tend to have that volatility. So I think while it may have the potential to grow at the same rate, or who knows, maybe even more, the difference is you have a lot more volatility. So that's why it is a lot more aligned down an income play.
Yeah. And I get the income piece and positively geared property from the absolute get-go. When you start building out a portfolio is when, you start getting down a process where you might have properties that don't perform as well as other properties, but then other properties perform better at an income level.
Yeah.
So you might have a really good yielding property, you might have a really good capital growth property.
Yeah.
You can pair them together and there's lots of ways to do that. But that's the scale benefits, right? If you've got one, you can't scale. Two, you can't really scale. When you start getting more than that, you start getting this notion of scalability, and that is you've got to get the right ones first.
Yeah.
Critical success factor, get the right ones first that allow you then to leverage to accelerate, which then allow you to leverage to retire off. And that's the whole portfolio journey. But it all comes down to how well you acquire properties. That's the secret sauce. If you buy lemons, you're not going to turn them into limes, right?
Yeah.
So you've got to get that right. I want to chat about how what process you use, or whether or not you have a system around acquisition. How do you do things differently? We just got another break. I'm conscious that this is going to be a long podcast, but it's good stuff, and I'm sure our listeners are happy with Lachlan. So stay with us, everyone. We'll be back in a moment. Welcome back. Phil Tarrant from Smart Property Investment with Lachlan Vidler from Atlas Property Group. He's a director over there, and he's given us a secret sauce, and I get the point. around you need to look at your portfolio holistically. There's a initial bit, and then there's a middle bit, and then there's a end bit. And the middle bit is the key bit, because if you get past the first bit, which is a couple of properties, then you can start accelerating. But it comes down to how well you buy at every step of the way. So how do you approach acquisition? Have you got any just sort of ways you do stuff differently to others, or any proprietary way in which you go about doing it that you're happy to share?
Yeah, absolutely. We have a few core tenets that we work off, and I think the beautiful thing about what we do versus maybe another buyer's agent, but definitely also versus just your everyday mum and dad or sort of very retail level investor who might only buy a few properties for themselves ever, is that we get to see a lot of properties.
You do.
Yeah, I wouldn't even want to try and guess the number that we see a week, but naturally we reject the vast majority, right? Because there'll be, there could be a lot of reasons why. It's not necessarily that it's some, secret thing. It could literally just be that it's in a flood zone, right? It could be something as simple as that, or it could be something down to we can't extract enough value out of the purchase of the property. So one of the first core tenets is, we're always looking to buy those properties under market value. Now, with our experience and a bit of my own education, we're very conscious of our ability to establish market value on properties. And if we can't get a good purchase price on it, we're just going to walk away, right? Now, sometimes fair market value on a great property is worth doing, right? Yep. So it's not always about can you get 50 grand off the purchase price. But I would say in the vast majority of cases, it's sitting there going, where can we build in that, 15, 20, 30, maybe more $1,000 so that we can look at our client and say, this is the proof. This is why we're going for it. What do you think? Because if we can't get that and there's no other redeeming features to the property, right? It's just an okay property, but there's nothing else that really redeems it. We'd much rather wait for the next volume of properties we're going to see to then go, that is a much better deal. So that's the first thing I'd say. The next thing I'd say is that cash flow, really important, especially in the early stage. And I think that, this tenant, so we've got three tenants. First one is that undervalue type prospect. Yep. This is the second of our three tenants. It probably does apply a little bit more towards in that early stage where you're building out your foundation, but, we really do need to target those good cash flow properties. Now, as we've spoken about, at length today, right now, maybe that means you are a couple of K in the red, okay? And that's just the cost of doing business. And if you're buying a good property, you'll far and away outstrip that, right? But when things start to normalize a little bit more again, it really is looking for that neutral, right? That neutrality in the cash flow.
Yeah.
And where you can, putting a bit on top, because at the end of the day, it is all about helping your serviceability. That's what it comes down to. It's not getting rich. No one can see it again except the cameras for the people watching YouTube, right? In inverted commas. That's all about the acceleration, right? Like getting rich, that comes out of your middle stage, your portfolio where you're really accelerating that. Right now, we're focusing on building that asset pool, and that's why we need that, the good level of cash flow, all right? Mm-hmm. And our final tenet is we need to have the ability to generate an uplift in the property. Now, it doesn't have to be immediately. And a lot of people, I can't even tell you the amount of clients we talk to who go, oh, okay, we've now got this property under contract. We're really excited. Oh, cool, we're now unconditional. All right, how can we spend our money on this property to earn more rent or get more value? And often we actually have to say to the client, spending 20 or 30 grand on this property, which doesn't need it to start with, right? You can throw a tenant in immediately, right? That's a really key thing that we do. We don't typically want to buy properties you've got to do work to get people in. But doing that work and taking that 20, 30 grand, if you don't need to do it, that's detracting from your next purchase. And yeah, you might get a good uplift, right? If you put in 20K, we probably want to get a good 50, 60K uplift out of that minimum. But what's better? Keeping that money and going towards trying to buy another property that could be, 4, 5, 6, 700,000 and you're getting growth. Even like 3 or 4% growth on something like that is going to be a lot better than trying to spend the money on, just a bit of an uplift right now. Let's do that later. Let's focus on building that pool in the early stage, because that's how you're going to build wealth, is get that pool. Doesn't need to be 30 properties wide, but get that pool out, get your second, get your third, break through that 9% barrier of property investor numbers, get your third, maybe get your fourth, and then maybe we turn back and we look at how can we make our current properties more efficient.
That makes sense. And I guess the key thing there is time.
Exactly.
Yeah.
Time.
It's not going to happen straight away.
And a lot of people naturally are really impatient. I think something we work, we work really closely with our clients, right? We develop really great relationships. We have a lot of touch points with them because we understand it can be a really challenging journey. And a lot of that is because it doesn't happen overnight.
Yeah.
And when someone knows, hey, this might be a 10-year journey, this might be a 20-year journey. It's, it's great to have somebody there that supports you and understands that, because most people won't have that, from their friends, their family. That's why, there's a lot of problems with retirement in the country, is because a lot of people don't have that wealth built themselves, and it's really challenging from somebody to be trying to go down that pathway and not have that support anywhere. So that's something we try to do a lot with.
And that's another point back to the government, right? Like, the government is in on this because what the government wants is self-sufficient retirees.
Yeah.
And how do most retirees become self-sufficient? They might get lucky on the share market, but most retirees will be largely self-sufficient or not need income from the government because of property.
Yeah.
And they're even now changing the rules around how pensions are going to be sort of assessed based on, your principal place of residence, which has always been off the cards. Like, they're now saying, no worries. And what will happen, I think, is that you'll start seeing a lot more. I reckon that's maybe an eye towards accelerating transactions, because if pensions aren't available for people because they look at the family home as something that's bundled up, they're going to have to sell those properties and make them accessible, which means that you're going to get downsizing and stuff. So that's a way to stimulate the market. Don't really have too much of an opinion on that, but
super funds as well.
Right? Like, the government wants self-funded retirees.
Yeah.
That's the goal. That's the reason why superannuation was introduced in the late 80s. The government doesn't want to be paying people pensions, right? They want to put that money elsewhere, or they want pensions to be given to those people who need pensions.
Which I think is
which is great. What a great place to live, where irrespective of how well you play the game through life, you're gonna get some bucks in your back pocket to live when you're older. I think that's great. It's one of the great things about Australia.
It'll be interesting though and I'm not fully across, and it's not my job to be either. That's the accountants and that's the lawyers and everyone else in between, financial advisors. But these changes to super, where they're going to be looking at unrealised capital gains as the valuation of the fund, and then the extra tax that comes on above $3 million. That's, and
unrealised capital gains. How are they going to work that out?
Yeah,
right?
and it's not going to be indexed. At present, they've said it's not going to be an indexed value. So that is going to be something really interesting for a lot of people. Right, if you're in your 30s right now, and you're starting to build out, and you're looking like, maybe I'll do an SMSF, which can be fantastic for property. Then in 30 years' time, that puts them at 60. That's still not even retirement age. So it's 35 years. I'd say, based on historical trends with property, stripping past $3 million of a super fund value in unrealised gains because it still own the properties.
Yeah.
Going to be interesting.
And that's where accountants will come into play, because I've got a self-managed super fund, but I'll probably make sure that I'm buttressed against potentially future rules. And sometimes they go, oh, well, grandfather. A lot of times they just go, nah. And people just go, but you've told me to create wealth through super, so I'm not a burden on the state through needing a pension. And now you're hitting me at the back end of it. Now, there'll be certain parts, elements of the Australian political spectrum would think tax the rich, right? Fair enough, you can have your opinion. But we're not talking about that. What we're talking about is property is a good asset class for creating choice.
Absolutely. And
in the future.
And something I say to, again, a lot of our clients, and even friends and family I talk to, is, don't sweat the things you can't control. At the end of the day, if the government changes rules, if they change tax, if they do this, if they do that, if the Reserve Bank increases the cash rate, all this stuff, this is white noise, because you have no control yourself.
Can't do much about it.
Exactly right. But what you do have control over is, how are you going to set yourself up for your retirement? And if that's shares, that's brilliant. We're obviously talking about property, and it's what you and I both love. But whatever your vehicle is, it doesn't matter. But for a lot of property investors and a lot of people who, I do talk with, it's always, oh, but what if this? But what if that? But what if that? And it's a lot of those people that do nothing because of all these concerns that they can't control anyway. And then they look back, and we get a call 3 years later or 2 years later going, should have just done it. And then, and
you get all the time. You ask any property investor, what's your biggest regrets? They go either, I should have started earlier, or I should have done more when I could.
And the best part is, any changes that might happen, you're probably not going to be the only one that feels
You're not
it.
going to be the only one to feel it. I would rather, and if you've got to get a philosophy around what Lachlan's talking about there, you could either be at a point in time where it doesn't affect you because you've done nothing.
Yep.
Or you've gone about building wealth through property or whatever the other asset class is, and you've got to work it out when you get there. I'm telling you, 99.99% of people would probably deal with, I'll work it out when I get there and deal with it rather than not have anything.
Yeah.
That's the choice, right? But fundamental to all of this, Lachlan, and I'm conscious of time, is how well you manage your portfolio on the way through and how you, and I spoke about beforehand, the P's in property, right? Performance.
Yep.
Performing property portfolio. Perpetually performing property portfolio that produces profitable profits.
Properties.
Property profits. So
have you ever? I know we're not going to have too much longer to keep chatting, but have you ever seen Super Troopers?
Yes,
the movie?
I have done.
Yeah, when he's got to do meow, and he's got to count it out.
Is that that's not McLovin? No,
that's Superbad.
That's
No,
Superbad.
they're the
Super Troopers.
They're the highway
yeah,
cops.
Yeah.
You make me think about that with the peas there. He's got to do the meow, and he's got
That's
to count
right.
up how many times he does it.
Yeah.
At the end,
I like it.
Meow.
So how do you meow the? How do you manage your property? How do you track performance? Because if you don't map performance, you're running blind. And you made the point around your driver boat. I guess is the right language. Driver boat. Got to get your head up and out of the data and actually see what's going on. Pilots call that situational awareness, right?
Yeah.
So
it's a great term.
You're getting inputs, which is technology and stuff. Telling you. Then you got to get your head out of the cockpit and look around. Yeah. Like there might be a blip on a thing that says there's a plane over there. You got to look for it, right? So the same thing what you're talking about. So if you're not mapping, if you don't have situational awareness, it's going to stifle your ability to make better decisions. Yeah. So you've got to track performance.
Absolutely. I'd say there's two prongs to this as well. Firstly, you need to track performance because if you've done this right and, like people we work with, right, building out that property plan, you need to track the performance to measure yourself against the plan. Because if you're ahead of track, that's great. Capitalize. If you're behind track, okay, why? What do we need to do to get back on track? And if you're on track, great. You know that you just keep plugging along as you're doing because the plan's working, right? So that's the first part I would say is why it's important, is because you're then benchmarking and measuring yourself about where you're meant to be. But the second part is a lot of people, I'm just going to call a spade, and ironic to use that as the analogy, they keep their head in the sand, right? Because it's uncomfortable or they don't know how to do it. And I'd say that's a massive one, right? To be able to manage and track your performance, you've got to be really good at Excel, okay? And you've got to be really diligent about doing it. And, you've got to be able to know how to make all these calculations, track it over time, make sure it's all in one spot. Don't lose the file when you change computers. All these different things. You've got to be able to do it because most property owners are going to own the property for 10, 15, 20 years. So you've got to have all that there at your fingertips to do it properly. Yep. And A, most people can't use things like Excel very well. B, it can be really cumbersome to use because if you don't use it every day or you're not, a finance whiz, it's a challenge. But more than anything, it makes people get in that boat where they are that, 14K in the red because they're not looking. It's just, money out. Oh, should be right. Mm-hmm. And then suddenly, if they actually sat down and looked at their performance, then they'd go, oh my God, like this probably isn't fitting the plan, which I never created, which I need to create. And B, if I have it, oh my God, we aren't performing, Should we be selling this? Do we keep holding? Are we ready to buy again? Like, we have no idea. The amount of people who come to me and they go, we've got hundreds of thousands of dollars of equity in our property and we have thought on and off for years about investing, but we actually didn't even know about this equity until 6 months ago. Wild. The wealth that could be generated by just managing and tracking that performance properly is crazy. And I guess this brings us to where the announcement comes.
Yeah, what's the announcement?
So I've been really lucky to partner up with a really good co-founder, and we're actually launching a brand new prop tech. All right.
Okay.
And the new prop tech, it's completely different to what I do in the buyer's agency space. It's a completely standalone business. It's called Talvr, so TALVR, and it is designed as a property performance management tool. All right. So extraordinarily user-friendly. What people are going to do is they're going to jump on the website, they're going to sign up, you're going to put all your property details into the platform, and then it is going to manage and track the property performance for you, all right? You're going to get monthly valuations straight from Price Finder or Domain, right? You're going to get that plugged in straight away. You're going to be able to manage your expenses. You're going to be able to see performance metrics. So you can see the growth, you can see the cash flow. You're going to be able to manage your tax return for the property out of it. So you're going to be able to put in all your expenses so you can see that cash flow. And at the end of the financial year, you're going to be able to hit export and you can send that spreadsheet straight to your account. It's going to take you 2 seconds, all right? There's calculators on there. So if you're trying to work out what's the cash flow on a potential property, you're going to be able to look at that. What's the stamp duties? What's an idea of our borrowing capacity? All those little calculators, you're going to be able to save them as well. So you can jump in and you can start to get a really holistic understanding of where you're at right now. So best part is it's going to be free to use. All right?
Free.
So everyone who goes and jumps on and jumps in now, it's going to be free to use for you. All right. And you're going to be able to put in all your properties and manage your portfolio more effectively. For those of you that don't know how to use Excel, it scares you. You're going to get great graphs. It's very colorful, very user-friendly. We've had great feedback.
So it's good
from all of our
interface, good
testers.
user experience.
Exactly right.
It's visual.
Exactly right. And that's that's a big key part out of Excel as well is it's not very visual, and even the graphs you do.
You've got to work hard to visualize
Exactly
it.
right. So we're going to invite all the listeners to come on. It's going to be free to use. Eventually, people who come on after you guys are going to have to be paying, right, when we get down that road. But right now, you've got the ability to take advantage to use it for free.
How do you
right
do it?
Now.
What's go to the website or something?
So you're going to head to our website. So talver, talvr.com.au.
Talvr. What does Talver mean?
Talver. So it's funny you say that. We were sitting there, we're trying to come up with a great name. And the funny story is you'd be surprised how hard it is to get a good domain name.
Yeah, it's very difficult.
So we were sitting there, we were writing up lots of words. We were trying to work out, what could be something interesting. And the TAL is from capital. The V was from investment and the R was from return. And it was a bit like that scene out of The Hangover where Zach, what's his name, Galifianakis or whatever his name is, he sees all those numbers just appear. We had that moment. We just smashed those words together. And what we decided was we could have called it prop something or something else. But most of the time, even when you say that, people say, so what do you do?
Yeah.
And we sat there and thought, we may as well have that exact same conversation, but stand out in the marketplace.
Fair enough. What's it like being a prop tech entrepreneur?
Exciting. We're loving it.
Expensive, I reckon.
It is. But we've got a great partnership with Domain.
Okay.
All right. So that's
cool.
that's really helped us out. And
so you got to tie up with those guys, have you?
Yep. So they're helping give us some data. And like I said, people are going to get monthly valuations on their property straight to the platform. So that they can keep track of that. And it's really exciting. Like I said, the feedback on the platform has been amazing. People have talked about how they weren't tracking things before, they weren't managing their properties, and now it's just incredibly user friendly. And then it's it's been a game changer for a lot of people. And we're going to be building out some features. So before the end of the year, we're expecting we're going to launch the second set of features, which is where there's going to be a business side. So you're going to be able to have your buyer's agent on there, being able to track your portfolio with you. You're going to be able to have some of your other professionals there. So you're going to be able to stay connected with your professionals and know that they're looking at what's going on for you.
I'll give you a hot tip. Your accountant will be happier if you could provide your information in one singular package than in drips and drobs.
Absolutely.
It's a nightmare.
Yeah. Well, I mean, we use the same.
Which means you get your tax done earlier, which means you can potentially get a return earlier, which means you can do stuff more quicker.
Absolutely. I mean, just the fact that was a really key bit of feedback we got. The fact that when you put your expenses into your property and at the end of the year, you literally just click the tax report and you click export and it puts it down into categories, it puts it down to the values, the aggregates, and you literally just send that to your accountant, whether you got one property or five. Yeah. It's there. And because you can actually hold all your receipts in the platform as well, it means if you ever get, the ATO come calling or you go, oh gosh, I can't remember how much that cost or that doesn't seem right, you can just go straight and grab your receipt, check it out, So we're really excited.
So it's live. It's
live.
It's
up. It's up and going.
The cat's out of the bag.
Cat is out of the bag. We're excited to get users. We're excited to get your feedback as well. We're going to be really responsive. We've built something that we know is going to be really valuable, and we've had that feedback. But once we start to get all the smart property investment listeners on there, we know we're going to get some great feedback, and we can't wait to innovate that to make the platform even more user-friendly and even more productive for managing those portfolios.
And this is the point, right? The better you manage your portfolio, the better the property investor you're going to be. And
Exactly
most people
right.
sort of shy away from it because it's a hassle and it's hard and all that. So it's good to see that you're creating something that makes it easier. And I guess that's the idea. So where do they go?
So you head to Talva, Talvr, talva.com.au, and you'll be able to create a free account, jump in, put all your properties in, and you're going to start getting insights straight away, which is going to be fantastic.
Very cool. Nice one. Well, thanks for coming in, Lachlan. It's good to catch up.
Thanks for
good
having
to
me,
see
Phil.
you.
We've got a marathon episode today.
Yeah, I know. It's an hour, but I'm sure our listeners will be happy about it. It's surprising how many times I get contacted saying, "Can you do one of these a day?"
Yeah.
Like there's such a demand for it. So
Yeah.
doing an hour is okay. But that's Lachlan Vidler, director over Atlas Property Group. You can go and check these guys out. Not to give people too much information, but if people want to be on you at Atlas, that's all cool.
Yeah, well, so I mean, I guess it's really two, isn't it? So if if you're really looking to come and expand your portfolio, be part of our great client base, have that plan built for you, and move yourself into that top 9% and beyond, come and check us out, atlaspropertygroup.com.au. And then for everyone else that wants to, manage their portfolios more effectively and grab those performance insights and those valuations and things like that, jump onto Talva, Talvr, talva.com.au.
There you have it. Well, I won't give any more information because then other people will forget what you just said. But thanks for tuning in, everyone. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.